Hello! Are you following the stock market or perhaps even investing in stocks? Or are you staying away from that space because you have been told that investing in stocks is just like playing in the lottery or going to a casino? My name is Jimmy Lepping. I'm a psychologist and statistician with a range of interests, including the financial markets. And in this video, I explain why investing in stocks is not like going to a casino. This video is not in any way intended to drive people towards investing in stocks or to be used for financial advice in any other way. I just want to address this urban legend so that hopefully at least more people can engage in more informed decision making instead of basing decisions on urban legends. So, if for a moment we suppose that the stock market is just like a lottery or a casino, we basically assume that the same expectations with regard to gains or losses over time are valid for these different types of activities. Now, casino games have been designed such that the odds are against the user and in favor of the house. And the same holds for lotteries. Although if we win, we can win a lot, the probability of losing is much bigger, such that the longer we play, the more we are likely to lose. Yet in the stock market, at least if our stocks portfolio is sufficiently diversified, we see the reverse. The longer we play, the more we are likely to gain. Let me show this with an example of 30 stocks that have been listed on the Amsterdam Stock Exchange for over 25 years and together represent a fair mix of large, mid and small caps and together represent 10 different sectors. I took the dividend adjusted yearly close for the 25 consecutive years that you see here and calculated the percentage of difference for each stock for a 1, 2, 3, etc., all the way to 15-year investment periods throughout the specified time window, and therefore yielding 24 data points per stock for a 1-year time window, 23 data points per stock for a 2-year time window, etc., and 10 data points per stock for the 15-year period. So an example of a 5-year time window could be someone who at year end of 2018 decided to buy stocks and sold them at the end of 2023. And this chart presents the median gain for each time window, which is lowest but still positive for the 1-year time window and highest and well over 100% for the 15-year time window. Does this mean that investing in stocks is without risk? No, that would not be a valid interpretation. However, it does show the tendency that gains tend to be bigger when stocks are held for a longer period. Now, this chart indicates not only the median, but also puts the median, which is the middle line here, in perspective by placing around this median the percentiles 10, 20, 30, 40, 60, 70, 80, and 90. So the lowest line in red represents the 10th percentile, whereas the 90th percentile is represented by the most upper line. Now we see that for the smallest 5 time windows, the lowest 3 percentile categories are in red because they are negative, indicating a negative gain, which effectively means a loss. Unless, of course, you decide not to sell yet at that point. Then, starting a 6-year time window, only the lowest 2 percentile categories are in red, meaning the other 8 in blue are positive. Placing actual percentages here, we see that for a 1-year time window, there was a positive outcome in 61% of the cases. Starting a 6-year time window, we see more than 70% positive outcomes, and for the 15-year time window, this is about 75%. This picture shows pretty well that investing in stocks does come with a clear risk. Even though the expected gain is more positive as we hold longer and longer, if you randomly picked one stock and held it for 15 years, there would still be about 25% chance of a negative return. And this is where we find one of the nice features of diversification. That is, instead of putting your money in one specific stock or in one specific sector or industry, which may do well, about average, or poorly, we invest in companies from different sectors and industries. For example, if you hold 10 stocks, even if 2 or 3 go negative, the other 7 or 8 may more than compensate for that, such that the overall result is positive. So to recap, while in a casino you can expect to lose more money the longer you play, in the stock market, longer holding periods tend to result in bigger gains. Or, as some put it, in the stock market, most money is not made by selling soon, but in the waiting. Buying and selling stocks on a daily or weekly basis for 15 years is of course not the same as buying and holding a stock for 15 years and perhaps even add to that position over time. That's very important to see this distinction. Buying and selling on a daily or weekly basis is actually referred to as trading, which is not a practice that I would like to criticize. I just think it is helpful to distinguish between this short-term perspective strategy and a longer-term strategy which is about taking a one or preferably multi-year perspective and is called investing. In this respect, I found it fascinating to see people steering clear from the stock market because it is just like a casino, while they are apparently comfortable playing in the lottery for many years, which, well, if you are lucky, can make you rich, but is actually much more likely to result in bigger losses the longer you play. A probably much more promising way to build wealth, provided patience, meaning a longer time horizon, and also a healthy diversification, is the stock market, where, contrary to the casino, one can actually expect to gain more over time. And I think this is a nice point to end this video, which I hope you find helpful. If you have any ideas or suggestions for future videos, just leave a comment below this video or drop an email to lappinganalytics@gmail.com. Thank you for watching, thank you for listening, have a good day and see you soon.